Welcome to our webinar this morning, which is entitled Mergers and Acquisitions, the Tax Angle Through the Buyer's Lens. Now, you might be asking why we're doing this now. I think part of the reason, or the main reason, is that what we've been seeing since the 1st of January this year, almost to the day, is a significant uptick in merger and acquisition activity, certainly coming through our firm and from what I understand elsewhere. Probably part of the reason for that is a lot of pent-up demand during the 2020 lockdowns, etc., where we've seen a couple of things. First of all, a number of businesses, good businesses, inevitably going to the wall or falling into distress, but at the same time, the US government pumping 1.9 trillion US dollars into the global economy, which means, and in fact, they're not the only ones. That's been going on in a number of countries as well. The result being that the world, in some situations or some parts, are awash with cash. We have on the other side distressed assets, distressed businesses, distressed people, many of whom are very valid. It just happens they've gone through bad times. So we've got a lot of cash available potentially to chase some of these assets, and I don't think that this is going to go away. And of course, there seems no signs of the cost of debt increasing, which also means that acquiring assets can be done quite cheaply. So our view is that 2021 and following is going to be the era of a new frenzy of mergers and acquisitions. So we thought that it might be timely for a little refresher for everyone. This is what we would call Mergers and Acquisitions 101 from the tax perspective. By definition, it's going to be relatively broad, but hopefully you will get some useful information out of it. Now, my name is David Sanderson. I'm the practice leader and head of tax for Grant Thornton here in Singapore. I'll be doing the first half of the presentation, and then Eng Min will be taking over from me. Eng Min is a very seasoned professional in Singapore tax, having been in the Big Four, having lectured at university, having been in industry, and now, very thankfully, working for us, heading up the corporate tax and advisory practice in Grant Thornton, Singapore. So I think on that note, let's take a look at today's agenda. So we're splitting it down into basically three parts. First of all, we're going to look at holistically the investment life cycle, and what are the key points that we need to consider, what is going on and what we need to do. We'll then be moving into what everyone should be doing before they step into buying a business, is the tax due diligence. Of course, tax due diligence will ride alongside financial due diligence, legal due diligence, and all the other pieces. But we're here today to talk about the tax piece. And then the third part really is, once you've done the deal, in many cases, the shape and size of what you're acquiring won't automatically fit into your present structure. Sometimes you may be lucky and it just slots in perfectly. Other times you may have had to buy a rather awkward structure or one that is separate from how you want things to be going forward. So we'll be taking a look at how we shuffle things around after the deal has been done. So the investment life cycle essentially is broken down into three pieces. There's the acquisition of your business, of your shares. There is the holding period, and then there is potentially the exit. Now, the only, I suppose, common denominator in in these, depending on what your business is the acquisition phase. Obviously, if you are a business making a strategic purchase, strategic acquisition that you're intending to hold indefinitely, then the holding period is going to be most important to you. And that's all around how do we get our business operations carried on through the most tax efficient locations, if you like. How are we going to extract profits from the ongoing business in the most efficient manner and get profits and dividends, etc., returns back to our shareholders. So you may not be so concerned with the exit. On the other hand, if you happen to be a PE fund or into startups which aren't expecting to be spinning off any profits during the turnaround or the growth period, then you will be more intent on looking at the exit and getting your structure ready for getting out with the least tax cost at the end. So different strokes for different folks. We'll be covering all of those because we've got quite a wide audience here today. So the first point is acquisition issues. What are the things that cause us grief at the point of acquisition? And the first one really is acquisition costs. So as a buyer, if I'm buying shares, there may be stamp duty costs. If I'm investing in shares, there may be capital duties in some countries. So we need to be aware that in addition to the price that we're paying for the assets for the business, there may be those various transaction costs. The other issue that obviously is fundamental to this is, what am I going to actually be buying? Am I going to be buying the business, which generally from a tax perspective, certainly from a direct tax perspective, means acquiring the individual assets and valuing them separately. On the other hand, you may be just buying the shares where all the assets in the business are sitting within the company. So we're going to be taking a look at what motivates you to do one or the other. Should I do a share deal? Should I do an asset deal? And then the other thing is that in certain situations, sometimes the transaction costs simply outweigh the benefits of doing the deals. No matter what you do at the end, these initial costs can be so large that the financials of the whole deal just get turned around. So let's look at asset deal versus share deal. And the tension really comes around looking at an asset deal because, as I say, what is good for the goose isn't necessarily good for the gander. So if you're the vendor, what you will typically want to do when you're selling a business, when you're selling the individual assets, is you'll want to allocate as much value as you possibly can to exempt assets, because that means that the company that you're left with doesn't get burdened with any tax cost, or it minimizes the tax costs. On the other hand, the purchaser wants the exact opposite. They want to acquire tax deductible assets, essentially. And probably the easiest example of that is inventory. You buy inventory at a certain cost, you get a tax deduction essentially when you sell it. On the other hand, something like goodwill, certainly in a Singapore context, that may be involved in the transaction, that could be regarded as tax-free in the vendor's hands. So you're always going to get this tension around purchase price allocation when you do an asset deal. But in general, the considerations aren't just the tax costs, but also a heap of other things that may be going on around the deal. You know, what is the outcome good for us to do an asset deal, but are the costs, the administrative hassle, etc., too difficult for us to contemplate it? Oh, sorry, can I just go back a little slide there? I missed off a last bit. Yeah, and I think quite an important point there. You might want to have the choice as to whether you do a share deal or an asset deal, but if your vendor is bigger than you, they say, well, take it or leave it. We want to do a share deal or we want to do an asset deal. So up to us, not up to you. So sometimes you may be stuck with it, which is why, as I mentioned earlier, you may be acquiring things in a shape that you don't actually want them, which is why you'd need to do some post-deal restructuring. So the advantages of the asset deal is that if assets have been increasing in value, then you can acquire those at a higher rate, which means you get enhanced tax depreciation if they're fixed assets, or if you happen to be in a capital gains tax regime, you might get a step up in the cost base of those assets, so that when you sell them, there is a lower gain that falls into tax. The other advantage of an asset deal, certainly in a Singapore context, is that it facilitates the introduction of fresh debt. And why is fresh debt important? Well, that's because fresh debt has interest on it. Interest is tax deductible, and tax deductions reduce your tax on an ongoing basis. In Singapore, it is particularly difficult, well, almost impossible, to introduce debt into a share deal, which is efficient for the simple reason that shares tend to produce exempt income, and there is nothing for that interest to be deducted against. Whereas when you are borrowing to buy assets that produce taxable income, then that interest is tax deductible. So an asset deal gives you a lot of leeway in terms of efficiencies in your holding period going forward. The other advantage of an asset deal is that all the skeletons that might be in the cupboard if you bought the shares, and that is not only tax skeletons, but legal and financial skeletons in the cupboard, i.e. it's not what you were told it was, then you inherit all of those with a share deal, whereas you leave them on the table for the vendor to deal with in an asset deal. So I suppose the overall conclusion is that for the purchaser, he's better to do an asset deal if he can, and also if he can get the right purchase price allocation in relation to the assets that are being taken over. So what are the areas of focus in an asset deal? I mentioned two of them there, goodwill and inventory. And the reason that those two are picked out is, as I mentioned, one of them gives rise to a capital profit for the vendor, which means no tax. Inventory, he would be taxed on if he sold at above cost or at a particularly high value. So he's going to want to allocate as much as he can to goodwill. We're going to want to allocate as much as we can to inventory. In between, you've got things like intellectual property, fixed assets, which don't get necessarily immediate tax deductions when you buy them, but they still may qualify for tax deductions over time in the form of, say, capital allowances, etc., etc. Trade receivables can be tricky because when you buy things like trade debts, which turn out to be bad, you may struggle to get a tax deduction for the write-off of those debts. So typically what we'd be looking at is writing those down as much as possible in the deal, so that we don't get stuck out of position paying too much for an asset that then turns out to be worth less and we can't get a tax deduction for it. The same goes with provisions. You've got to be very careful that those provisions can then be tax deducted as they're paid out in the acquiring entity. And as I mentioned earlier, funding the acquisition is very key in terms of being able to get the tax efficiencies of the interest expense deductions. So the disadvantages of an asset deal, typically you'll get higher stamp duty costs, particularly where you've got real estate involved. But as you know, in the case of Singapore, with certain companies that own residential property, there are look-through provisions which mean that it's effectively as if you'd sold the underlying asset, even if you do a share deal. But you've got to understand those. You've got to understand what the costs are when you're making that acquisition. GST and VAT, depending on the country, may also apply when you're buying assets. And that means a cash flow disadvantage because the vendor may be required to charge you GST. And although you may be able to get it back, it does mean you got to swallow that cost up front until you do. However, exemptions may apply. Transfer of a business as a going concern allows the transaction in Singapore and many other jurisdictions to take place outside of the scope of GST. From the vendor's perspective, tax depreciation recapture if you're selling fixed assets, which we call a clawback of capital allowances, tax depreciation, so that's a cost. And there may be capital gains tax issues in CGT countries. If the vendor has owned the assets for a number of years, there may be a build-up of what we call pregnant gains within the assets themselves. Then the other issue around an asset deal is it's just much more complicated. As I mentioned, purchase price allocation, you've got to haggle over that. You may have employment transfers where employment contracts have got to go across. Certainly in the context of Singapore, employment pass transfers, etc., etc. You've got to transfer your open contracts, transfers of title to property, etc., etc. So although for the purchaser, an asset deal may be more tax efficient, there's a hell of a lot more work that is going to be involved in doing with that. So we have our first poll question. What are the buyer's concerns on a share deal? We've looked at the advantages and disadvantages of asset deals. What about shares? And it may not just be concerns. What could the advantages be? There we go. Reputation. Valuation. Yeah, okay, this is all very interesting. Well, I think I saw enough on the answers to suggest that people have a good grasp of what the issues can be. Yes, skeletons in the cupboard, i.e., we're getting everything lock, stock, and barrel. The other things, warranties and indemnities, i.e., is the vendor still on the hook for stuff that crawls out of the woodwork later on? But of course, part of that is the question of whether they're good for the money in due course. In 6 years' time, they might have gotten bankrupt and spent it all. What is your comeback on that? There was other things about record keeping, yeah. And I presume that's what the financial due diligence piece will be looking at, i.e., historically, have they produced a sound set of books? Can they be relied on? And can they be relied on to produce the figures that they said they were going to do later on? The advantages of a share deal, I always like to look on the bright side first. As we mentioned, much easier to effect a share deal. Simply sit around the table, sign a couple of documents, shake hands, and then get on with life, and it all happens. Typically, transaction costs will be lower. As I mentioned, things like stamp duties typically are lower in relation to share deals, but not in all cases. Some jurisdictions, as in Singapore, for certain transactions, have look-through provisions, and therefore it makes no difference whether you do a share deal or an asset deal from that perspective. Share deals, no GST VAT implications because the transaction is either exempt or zero rated. No effect on the underlying assets, so the vendor isn't getting hit with clawback of capital allowances or capital gains tax. And if the assets are increased in value, then we get the hard cost base if we want to sell out of the company later on. The advantage of the share deal for the vendor is he gets rid of the skeletons, but of course he's not if you've got your reps and warranties sorted out in your agreements. He remains on the hook for some time. If we can look at the disadvantages. As I mentioned, in Singapore in particular, a share deal reduces the debt pushdown opportunities. It doesn't in places like the UK. So for example, you can put a bidco in that borrows to buy shares in a UK group. That interest expense can effectively be group relieved and set off against the profits of the business that you've acquired. In Singapore, you cannot do that. And Eng Min will be looking later at some debt pushdown strategies that can try to address that situation. The warranty period means although you've sold the thing, you think you're out of it, but it means that someone's got to keep a track on it, go back and check that nothing has crawled out of the woodwork that wasn't provided for in the sale and purchase agreement. The purchaser inherits the CGT potential and the clawback of capital allowances of the underlying assets. So that means in some situations that you would want to be asking for a discount, because if you ever wanted to sell those assets directly out of the company you've just bought, you're going to be the one who suffers that tax cost. And so likely to be asking adjustment to price, downward adjustment to prices for those perceived, what I call pregnant gains. And as I say, the purchaser inherits all the skeletons in the cupboard, which is where tax due diligence comes in. Now, are we ready for our next question? So how can the buyer's concerns on a share deal be addressed? Of course, tax indemnity clauses, reps and warranties, etc., etc. But as I mentioned earlier, those are only as good as the people that are actually giving them, who might not be around in 4 to 6 years' time when you come to call on them. But the thing I'm looking for in there as a segue into Eng Min's piece is tax due diligence. So on that happy note, I'll hand over to Eng Min, who's going to take you through what we do in a tax due diligence, what we look for, what the issues are, and then take us through some of that post-deal restructuring that I mentioned earlier. So Eng Min, over to you.
Thank you, David. So I think from what I can see just now in the Mentimeter sort of input that you have given, due diligence is one of the things. And then we talk about reps and warranties. We talk about tax indemnities. We talk about insurance. But how do you know that you need all these reps and warranties, or you need all these additional clauses, or you need to negotiate with the seller for, say, a reduction in the price because of this inherent risk that you will be inheriting when you buy the whole company? Now, in this particular slide, what I've shown you is in a typical share deal, there are many, many steps. Today, we're only talking about at the point when you're executing the deal, what sort of due diligence that you need to do. And we're not covering things like financial, market, operational, or legal. We're just going into tax due diligence, which is one aspect of the DD that you need to do before you sign on the dotted line for the buying of the shares. Right, so typically, when you want to do a tax due diligence, I will ask you 2 questions. What sort of tax type are you going to cover? Are you going to cover corporate tax, GST, withholding tax, employers' responsibilities, custom duties, or what? So that is something that you may have to make an assessment based on your understanding of the company, the target, or the industry, as to whether any of these things will be of concern to you or more concern to you than the other. Then the second question that you will need to address in a TDD would be the period of review. Do you want to be very safe and cover all open years? Statute of limitation in Singapore for tax is 4 years from the year of assessment. So do you want to cover all open years? Or if you think of withholding tax, statute of limitation doesn't apply. So, is that like a real concern for you that you have to start from the beginning? Or you would just want to do 1 year first and see how comfortable you are after you do the duties on the target, and then decide whether you want to move on to an extended period. Now, remember, when you do a share deal, you effectively step into the shoes of the previous owner. So whatever skeletons that are hidden in the closet, they all belong to you. So you'll be the one holding the hot potatoes if IRAS come back and ask you some questions on some of the previous position that's been taken by the company. So the tax duty would help you uncover all these issues. Now, I'll start with corporate tax. So when you do a corporate income tax duty, what do you want to achieve? So typically what we'll do is we look at the control environment. How are the tax com prepared? Is it done internally by a certain group of people? Are they skilled enough? Do they have the proper qualification to do it? Or is it outsourced to another party to do it? And how do you actually provide information? How does the target provide information, say, to the service provider to do this, to do the tax computation? I have a situation where recently I've been asked to do a health check on a company. And I think what happened in the past is that the service provider will ask, are there any capital or these are non-disallowable items included in this head of expense? The answer is no. So merrily they submit the com to the IRAS. Now IRAS comes back and say, give me a listing of these items I want to go through. And then they scramble because they're not sure where to find the listing. So that control environment is important. We need to know how they actually do things and whether they can actually trace to the items that they require. Then of course the other more fundamental things would be like, has this target been a delinquent taxpayer? Have they been making payments on time? Are filings on time? Any outstanding CIT queries? Have they responded to CIT queues? Looking at the CIT queries would provide a very good indication of what sort of things that the Singapore Revenue is actually looking at as far as this company is concerned. So are there contentious issues? Did they take a very aggressive position on some items? Remember, because I've said that, I'm just repeating again, you step into the shoe of the target after you buy the company. So if they have taken a very contentious, if there are some contentious issues and they have taken a very aggressive position, it may hit you later on. Okay, so this one, maybe you can ask for a rep or warranties to cover additional tax exposure or penalties or whatever. But until you do the DD, you will not know that there are this sort of issues that you need to cover. And then of course, we also ask questions on their transfer pricing policies. Do they have contemporaneous transfer pricing documentations? Do they have enough support of all this related party charging that they have in place? So this is what we will uncover in a corporate income tax due diligence, which is quite key, because otherwise you're actually stepping into all these time bombs that may actually explode in the future. Now, earlier on I said withholding tax. The other thing that we typically looked at would be withholding tax. Now, withholding tax, unfortunately, under the Singapore rules, there is no statute of limitation. It doesn't apply. So technically, whatever liabilities that's been there from years ago would be there. Some other countries will have other country rules. If you're buying, a group of companies in the region, so Singapore, Grant Thornton Singapore will only be able to look after the Singapore portion. So the other countries sort of tax due diligence will be handled by the in-country expert. Each country has got different rules on this. So for Singapore, my experience would be, we have to ask, what has the company done to ensure compliance? Typically withholding tax is the liability of the payee, but it's the payer responsibility to withhold tax at the point when they make the payment. So the question we need to ask is that, what's our procedure they have in place to ensure that it's in compliance? Because, it's actually maybe at the accounts payable department, when they make the payment to this person, do they check, is there like a withholding tax? If there is, they ought to deduct a portion of it and send it over to the IRAS. So what sort of process do they have? So maybe the accounts payable, if they have a manual or they have got some kind of process that say that if you're making certain kind of payments to some non-resident, you need to check. So at least you have a comfort of whether they have handled their compliance with the withholding tax obligation correctly in this case. And then a lot of time, companies may actually apply the treaty rate. Treaty will actually give you a better rate than domestic rate, and you merely apply the reduced rate under the treaty. And once you have done that, you need to submit the certificate of residence by a certain time. And if you don't, what IRAS can do is that IRAS will actually remove the reduction, the reduced rate, and actually put a late payment penalty on the difference, as well as collect the difference in tax from you. So in terms of the target, in terms of their withholding tax compliance, have they done all this? Have they done this properly? So these are things that we are concerned. And then when it comes to the employer's obligation, now in the context of Singapore, we don't have a PAYE system. So, but a lot of overseas country has. So that would be something that ought to be checked on the PAYE system. In Singapore, we just need to sort of like watch out for two things, which is whether the IR21 has been properly filed and then the tax has been settled. Because the employer, the Singapore employer, has an obligation to notify the IRAS if there is any non-Singapore citizen or SPR leaving Singapore for good, Singapore permanent resident, SPR leaving Singapore for good, then you need to basically withhold the last month's pay, whatever money is in the hands of the employer in that month, file the IR21, make sure the tax is settled before you release the funds to the employee. If not, you would then basically have to pay that to the IRAS. And then the other obligation for employers in Singapore is that you need to do the AIS, auto inclusion system, where you have to put in all the employment remuneration details of your employee. I think tax filing season around the corner for all of us. So you really have to make sure that this has been done by your employer, and you basically can then go in and file your tax return. So as a target, if you are looking, if you're doing a duty on the target, these are the sort of things that we looked at. And then when it comes to CPF calculations and the employment law related sort of diligence on this kind of, on the employer's obligation, some part of it will be actually done by the employment lawyer. Okay, now the next item that we typically look at in Singapore and overseas would be the goods and services tax. Again, we need to look at the control environment is to see how taxes are collected and then accounted for to the IRAS. So for GST is a transaction tax, and the Singapore company is just like a collecting agent acting on behalf of IRAS. It's an end user tax, it's a consumption tax that is borne by the end user. So as far as the company is concerned, you have the input, you have the output. So input is whatever you have incurred, output is whatever you charge. So basically, you just need to account the net to the IRAS, and you have to make sure that in your claiming of your input tax, there aren't any block input tax. There's some cookie rules, certain things that you can't claim. So you have to make sure that there is a mechanism to make sure that all these block input tax that you can't claim have been excluded. And on the other side of it, we say that there are only two rates in Singapore, two GST rate in Singapore, 7% and 0%. So if you're doing a zero rating, is it done correctly? Do you have all the requisite information to support that zero rating position that you have taken? So all these things are quite critical, because if it's wrong, it will result in penalties. And sometimes some companies, every few years, they will do an ASK, their own self-review with the help of a professional firm. And if they have done this, at least someone has actually checked their GST filing positions, and if there are issues, it would have been highlighted, and then you may have spoken with the IRAS on how you can actually resolve it. And then whether the company has been invited to do an ACAP, and if the company has been invited, did the company accept the invitation to do, or have they declined? Would the target be on the IRAS radar screen because they declined to do an ACAP for whatever reason? And whether this particular target is on any GST scheme where there are conditions and record keeping requirements that they need to comply with. Right, so the other tax type that sometimes we looked at would be custom duties. Less of an issue here in Singapore, more so overseas, because our custom duties regime here is fairly limited only to the so-called sin tax, the cigarettes, and I'm not sure about liquor, whether I can say that or not, but okay, but basically limited to, those items. But for other countries like China or, Malaysia, Indonesia, this may be a big issue, the custom duties sort of exposure. Right, so in a share deal, we need to do a tax due diligence, and predominantly because we want to understand whether there are any historic tax exposures that the buyer would now become liable as a result of the transaction. You buy the company, you step into the shoes of the previous set of shareholders, you are responsible for everything. And then if you do a TDD, a tax due diligence, that would help you identify issues. So if there are issues that you need them to give you a reps or warranty, or if there are issues that you need them to put aside, some escrow funds to settle it, should it become a real tax liability, or you can even actually use it to negotiate, the terms, the purchase price of that deal, and then at the same time you will be able to sort of like suss out matters or issues that may affect the operations in the future. So that's the key, of what you can achieve in a share deal. Right, let me just move on. Okay, now we have decided to buy the company. And then having bought it, what do you, having decided to buy it, what do you do? Okay, I have one other question on Mentimeter. So, okay, now that you have decided that you're going to buy it, so what to do? What sort of post-deal structuring sort of idea that you can think of? Holding vehicle, withholding tax on remittance, yes. Okay. Right, okay. I will just want you to, deferred payment. Hold back until we settle all tax issues. Okay, obligators and guarantees. Yep, okay. So in terms of tax planning, I will go through some basic strategies that we may have shared with you before. So the first thing we talk about is debt funding. And debt funding is something so fundamental, especially in the context of Singapore, where most of the dividends, or I should say where dividends paid, not most, but dividends paid by a Singapore company is a tax-exempt dividend, and therefore, if you have any interest costs on the investment in the shares, you basically can't get any tax deduction. So the most ideal situation from the Singapore angle or from a number of countries would be that you should put the debt where the operations are. So basically, you then can deduct the interest expense on the debt against the profit from the operations. So we will try to do debt funding where possible, and if you can, push it down, right? And the next thing, I think just now we talk about withholding tax. Someone mentioned about withholding tax. So you have to think about, let's say, for example, if you're investing in a group of companies in the region, so what would be an ideal location for a holding company? But it is also dependent on what sort of income you actually want from this investment, which I will cover a little bit later. And David has actually spoken about it a little. So do you want dividend? Do you want interest? Do you want royalties? And so on. Okay, so the use of the treaties may help you minimize your tax exposure, mitigate your tax exposure, and minimize the overall tax suffered by the group. And then after you take over the operation, are there any opportunity for you to relook at the supply chain? Could it be that the transfer pricing policy is not right, or is it something that you can do about it to make sure that it will be more efficient? And then in terms of incentives, we still have the merger and acquisition incentive here, allowance here in Singapore. Used to have the stamp duty bit, but that since has been repealed. No more stamp duties sort of exemption. So it's just the M&A allowance that Singapore companies subject to meeting certain conditions can get. So that may be something that you want to think about. And also Singapore, we have pioneer incentives. So if you have a target that has got the pioneer incentive, you may want to look at to see how you can actually expand on it. Or if you are like, putting a number of companies together and you're expanding the kind of activities that you're going to undertake in Singapore, you may consider talking to the authorities to ask them, to apply for some DEI incentive or whatever, so that, you'll bring more business into Singapore. So that's a possibility for us here in Singapore. And then the last point that I have is the tax system arbitrage. The ideal of the ideal where you can have an instrument that's treated as debt in one country, so that you have interest and it's deductible, and then it may be treated as an equity instrument in another country. So that's something less of a Singapore sort of planning ideas, but maybe an overseas planning ideas. Yeah, but whatever you do, just bear in mind that because of OECD's focus on base erosion, profit shifting, we really truly must have a commercial reason on what, the steps that you're going to take, and the tax incentive or the benefits that you get. Maybe I should say is by the way. So basically it's commercially driven, whatever steps that you're going to do, but you will probably get some tax benefit out of it. Okay, so right, so we're back to what we talked about a bit earlier on. So if you are looking at your investment structure, then the question that you need to answer yourself is, are you looking for a recurring sort of a return in the form of a dividends, interest, royalties, or management fee? Or you're not interested in all this, you're more interested at the point when you get out and on exit. So are you focusing only on the capital gains on exit, or you want a recurrent sort of a return? So that would decide, that will have impact on how you structure. So basically, my next slide, I'll explain to you, how this dividends, interest, and all will be taxed. But the overall arching idea here is you need to know what's your holding objective, and then from there you can then decide on what structure you should be using. Okay, so if you are looking at dividends, we talk about dividends being an after tax, it's paid from after tax profit, so dividends are not tax deductible. And in a number of countries, dividend will be subject to withholding tax. Not in Singapore, but elsewhere, dividend will be subject to withholding tax. And on the other side of it, if you don't pay dividend, you look at that equity. So equity, you get dividend. And if you don't pay dividend, if you have interest, then interest is tax deductible. I mean, debt on interest on debt is tax deductible. But most time, you'll be subject to withholding tax. And there's some thin capitalization rules in some countries. Well, thin cap rules basically means that if you exceed that ratio, any interest that you pay in excess of the thin cap rules will not be tax deductible. Then you're actually back to square one. So it's no different from your dividends, which is not deductible. And if there are IPs involved, earlier on when we talk about if it's an asset deal, if there are IP involved, then you may put a royalties on it, but royalties typically will be subject to withholding tax. And if it's a related party sort of a transaction, it has to be properly transfer price. Or it could be a form of a service fees that you are performing some service for your target, and then you get a deduction at the target level. Generally tax deductible in most countries, service fees, but in some countries it's a challenge getting a deduction. And sometimes also there will be withholding tax, and then there are also transfer pricing consideration given that these are related party transaction. Okay, this is a very rough example, a very quick example of dividends versus interest. So what you can see is that if you put an interest of $40 into that equation, then the net tax suffered is 26% because interest is tax deductible, and the withholding tax on interest in this case is 20% versus the corporate tax of 30%. So that's why you have an end result of tax suffered of 37 if you put everything in as equity. But 26 if you put in part debt, part equity, right? So I'll just move on. Okay, so we all think that, we all know that it's good that we can introduce debt into our M&A transaction, push that down. And typically what you will require is a new co. You need to set up a new company to merge all these business that you have acquired, and then you need to transfer it in to the new company, and you need to basically establish the nexus between that loan and the new business in order to get the deduction. But you'll be subject to, thin cap rules, you're subject to some other local challenges, and in some countries there may be exchange control regulations that maybe that may not allow this. So one simple example of a debt push down that we could share with you is that you have identified the target. Because of the disparity or between you and the seller, you're forced to buy the target because you want the business. So you bought the target, but after you buy the target, you move the business out from the target to the new co. And then when you move the business out to the target to the new co would basically borrow, take a loan, could be from the parent or could be from anyone here. And then new co will take a loan, and then new co will actually fund the purchase of that business from the target. And here we are, we have got a link between the loan that was used to fund the business, and therefore we can get a tax deduction of that interest expense against the profits from the business operation. But the emphasis here is that you have to have commercial rationale for the transfer. And we talk about asset acquisition before, and there are quite a fair bit of a disadvantage, whether in terms of stamp duties or whether in terms of in-cap rules if you are looking at a loan. All right, so I'll just move on to the last slide, which basically we talk about exit. Now, on exit, there will be, if you buy a target, you buy a company and then you want to get out. So of course you said that when you sell the shares in the company, it is the purchaser who have to pay the stamp duties. Typically in most jurisdiction, it's a purchaser who pay the stamp duties, not the buyer. But that may have an impact on the purchase price if you factor the stamp duties in. So that may not be a cost to you, but it will affect the negotiation. And then some countries actually tax on capital gains, and some don't. Like Singapore, we don't tax on capital gains, but then always we have the difficulty of trying to decide, between the revenue and capital divide, whether a gain is capital or revenue. So some countries will tax on capital gains, and it depends on where the investment is. And okay, I'll just move on to just sharing with you, what a typical structure is, and then why, we do it like that, and what are the risks. Okay, now I have here a very simple, example of, I have a local investment vehicle, that's what I want. And then the question that we need to ask is that, what sort of investment returns do you want from this? Is it dividend? Is it interest? Is it royalty? Is it service fee? And if that's the case, then how do you actually structure it? All right, so in this example, I have a local investment vehicle, and then I have got a treaty between SPV1 and the local investment vehicle. And hopefully that treaty can protect or reduce the withholding tax on payments of interest or dividend to SPV1. And that would sort of like help mitigate the overall tax exposure of this structure. Then you ask me, why did I say that it should be SPV2, SPV1, and then local investment vehicle? Why so many tier? Now, one of the reasons why we have so many tier could be that potentially you can, instead of selling the local investment vehicle on exit, instead of getting SPV1 to sell the local investment vehicle, you may get SPV2 to sell SPV1, and this is not, happening here. The sale is not happening here, and therefore, technically, there should not be any capital gains here. So this is one of the idea that people used to have. I use the word used to have because some countries has introduced what we call a taxation of an indirect transfer. So some countries would still tax you, even though this is the local investment vehicle. You are not selling anything here. You're selling SPV1, which is in some other countries. So it's like a tax haven country selling SPV1, but this country would still want to tax it because the value of this transaction is in the local investment vehicle. That's where the underlying value is. So life is actually much more interesting now with tax planning. So we have to watch and check, the countries involved to see whether this is a viable option or not. Okay, right. So I have sort of speed through so that to see whether we could have some time for questions.
We had one question, but I answered it. So, yeah, and it was what ACAP meant.
Okay,
assisted compliance assurance program for GST, which is is really a way of finding out about your mistakes and not getting penalized for it in a way that you clean up your act going forward. So it's something it's a program created by the Inland Revenue to educate people around mistakes they might be making with their GST returns and the like.
Right, because it's GST is more like a transactional tax, so they want to make sure that your system properly record, the input tax and then the output tax. So it's like going through your system to see whether your system is acting correctly. You have properly coded your transaction to say this is a zero rated supply and this is a standard rated supply. And if your system is correct, then the end result, should be correct. And then IRAS actually give you different sort of status, and then they will not touch you for a number of years, if you achieve that. I think it's a platinum status or something like that. Yeah. So then they won't come and talk to you again until the next round. So at the start of before ACAP, IRAS actually co-share long ago. Like this really very long. Only for people who have been around for a long time would know this. IRAS actually co-share some of these costs, and we think that they're actually outsourcing the audit, of this internal control of companies to the outside world, to the commercial world. Okay, we have one country, sir.
We got another.
Sorry, one more question. Sorry, which countries have you seen more M&A activities recently?
Well, obviously Singapore, because we're in Singapore.
I have seen quite a number of Singapore companies wanting to acquire in the region, and the region would be like Thailand. I think it's got Thailand. It's got I think Indonesia and Philippines.
I've seen a lot of stuff in Indonesia coming online. And I suppose the reason we see that is because Singapore is quite a popular holding company location for
correct
into Indonesia. So that's on the inward side. But in terms of the purchasers, they come from everywhere. We've been dealing with purchasers from as diverse as Ireland to Japan, in doing deals in Singapore, but which quite often have a regional reach as well, sitting underneath Singapore. So typically if they're doing a Singapore M&A, there may be a whole raft of other jurisdictions that are involved in it. And of course, when you're doing your tax due diligence, you would be looking at all of those subsidiaries as well, to the extent that they are material, even though the acquisition may be taking place at the Singapore side. And the other one, of course, we've seen, which we were directly involved in, is the Ascendus REIT acquisition of the data centers in Europe. So that's an outward M&A activity, if you like. So a lot of stuff, a lot of interest from Singapore, particularly the REITs, looking out to acquire stuff. Primarily with a focus on Europe at the moment, and in particular the UK. UK seems to be quite a nice little niche at the moment, having Brexited. A lot of interest going in there.
Okay, David, we have another question. Are there any synergies that can be created if selling company prepare a VDD review? What do you think?
Yeah, well, the VDD reviews, I suppose, are sold as a package deal, saving costs for the vendor, and certainly it's a good thing to do, because what it means is it gives you an opportunity to find out what your problems are before somebody else does and tries to mess around with it. So it can give you an opportunity to do a bit of house cleaning. Tidy yourself up and get ready. Whether it actually saves money in terms of what the buy side DD has to do, not so convinced, because you still got to ask, when you're doing the buy side due diligence, you still got to ask the questions, you've still got to get the answers to those questions. It just may be that the answers to those questions have been anticipated and are readily available. So it can make our buy-side tax due diligence that bit easier. So,
I think,
what do you reckon?
That's right. I think you make the buy-side due diligence a little bit easier, but because there's always like a cutoff point when you do your VDD and things have moved or changed since then. So there's always a need to do an update of, what happened in the interim from that point, when you close off your VDD to the point when the buy-side actually comes in. And from our experience, I think there are a number of times where the buy-side actually asks us to work on the VDD, to basically review the VDD, and then from there work on it. So maybe we'll cut down a bit of time, because sometimes the VDD will actually raise some issues that has yet to be resolved. And then, from the buy-side angle, we will need answers to those. And obviously, we can see it from the VDD review.
Yeah. We have another one here. How do you think COVID-19 will affect value of assets going forward? Yeah, I think, as I pointed out at the beginning, I think COVID-19 has, in its own right, created a lot of stress in terms of asset values, et cetera, et cetera. And sadly, we've seen some very good businesses struggling and or going to the wall. My view is that good people, good assets, and good business thinking doesn't disappear. It's still there, but it may be available at a cheaper price than it was going forward. So I see personally lots of good value lying around. And one of the things we constantly hear is lack of talent. Well, that talent still exists, even if they were involved in a failing business. There may be good people that are still around and still available to be employed. So I see a bit of a meltdown coming once we've got through the job support scheme and all the other handouts. I think there's going to be some distress in the market. That doesn't mean it's a disaster. It just means things will move around, and that's why I think we're going to see a lot of M&A activity.
Yeah, I think there'll be a bit of rationalization, because some of these companies may be artificially prop up because of the COVID-19 sort of measures. So, I mean, it would be a good rationalization so that, whatever we need going forward will be there.
Happy for anyone to drop us a line if they want to have a chat, or if they're thinking of doing a deal or having a deal done on them. Happy to talk either way. So maybe on that note, it's time to say sort of cheerio.
Thank you so much for taking time to attend our session.